Before we dive in, hit subscribe so you don't miss new episodes. If you find value, click the like button so we reach more people. Let's get started. All right, let's plunge into something genuinely intriguing that's unfolding in the world of finance right now. We're talking about private credit. It's a market that's just exploding, right? And anytime you have that kind of growth, especially in, complex deal making, due diligence becomes absolutely critical.
Absolutely correct.
For a long time, thinking about private credit diligence felt pretty one-sided. The lender holds all the cards, asks all the questions, and the borrower just responds.
That's the traditional view, yeah.
But our source material for this deep dive, it paints a totally different picture for 2025.
It really does, and that's what makes this so compelling. Our source zeroes in on private credit due diligence, but it flips the perspective entirely.
Flips it how?
Well, it's not just about how lenders are getting more sophisticated with AI, which they are. It's about how borrowers are using these advanced tools to do their own deep dive.
Their own dive on the lenders.
Exactly. They're vetting the lenders, analyzing the market in real time, and essentially kind of taking control of the process.
Oh, taking control. I love that framing. So it's like a fundamental power shift enabled by technology.
Precisely. That's the core idea. The mission here is to really unpack this shift. How is AI specifically empowering borrowers, giving them leverage, and fundamentally rewriting the private credit due diligence playbook as we, navigate through 2025?
Right. Let's dive into the details from the source then. Okay, let's unpack this. To appreciate where we are, maybe remind us of that old world of private credit diligence you mentioned. What did that look like from the borrower's perspective?
Yeah, sure. Think about needing capital back in the day, maybe not even that long ago. You'd approach potential lenders, present your case, and then, well, you'd wait.
Just sit tight.
Pretty much. The lender's team, the credit analysts, the lawyers, the risk managers, they would descend on your business. They'd comb through your financials, scrutinize your assets, tear apart your projections.
Sounds intense.
It was. And as the borrower, you were definitely in reactive mode. You responded to information requests, you provided documents, you basically just facilitated their investigation into you.
You were essentially under the microscope, just hoping you had everything they needed and that they liked what they saw.
Precisely. Your job was primarily to provide data and answer questions. But the private credit market has matured dramatically. I mean, it's not the Wild West anymore.
Right.
It's become highly institutionalized, with massive funds deploying huge amounts of capital. And with that institutionalization comes a whole new set of expectations for borrowers.
Okay, what kind of expectation, what pressure are borrowers facing now that they weren't before?
Well, our source highlights that borrowers are under real pressure to present themselves with a level of transparency and discipline that really mirrors institutional standards.
So no more messy spreadsheets.
Exactly. You can't just show up with a great story and, some patchy financials anymore. You need institutional-grade data, as the source puts it. Clean, well-organized, verifiable.
Makes sense.
You need to be ready for incredibly sharp, technical questions about your financials, your operations, even specific legal clauses. And maybe most critically, you need to proactively identify and address potential risks before the lender even spots them.
So it's not just about having the right answers. It's about knowing the questions before they're asked and showing you've already thought about mitigation.
Absolutely. You have to demonstrate that you understand the complexities of the deal and your own business inside and out. And you need to avoid any hidden skeletons, reputational issues, past legal troubles, structural complications that could become deal killers later on.
The bar is just way higher.
Significantly higher. And this is exactly where AI is stepping in, not just for lenders, but as a powerful new capability for borrowers to meet these increased demands.
Okay, here's where it gets really interesting. How is AI specifically equipping borrowers to meet this higher bar and, as you said, flip that script?
Right. Well, the source details several key applications where AI is fundamentally changing the borrower's role, transforming it from like a passive recipient to a truly proactive participant.
Give us some concrete examples. What tools are they using and what are they actually doing with them?
Okay, one of the most immediate impacts is on document analysis.
Yeah.
Think about a private credit deal. You're looking at draft loan agreements, term sheets, security documents, intercreditor agreements, side letters. It's a massive volume of highly technical text.
Just mountains of paper or digital paper.
Thousands, potentially tens of thousands of pages. Just digesting that manually would take a team forever, and it's easy to miss things.
For sure.
And that's where AI platforms shine. Tools like Cura Systems, Evisort, and Luminance, which are mentioned in the source, can ingest that entire mountain of legal and financial text in minutes.
Minutes, wow.
Yeah, and they don't just read it. They understand structure, identify key clauses like covenants, repayment triggers, default terms, and compare them against benchmarks or even previous deals the borrower might have done.
So they can instantly flag things like, I don't know, an unusually restrictive covenant or a hidden fee structure that might be buried deep in the document.
That's exactly right. It allows borrowers to quickly pinpoint potential risks or clauses that deviate from market norms for this specific type of deal. It gives them time to understand the implications and, critically, go into negotiations armed with actual data.
So they can push back effectively.
Yes. They can say, look, based on market data for similar transactions, this specific clause on, say, prepayment penalties is outside the typical range, and here's the data. It moves the negotiation from just assertion to, data-backed fact.
That's huge leverage right there. Okay, so they can analyze the deal documents themselves. What about understanding the broader market landscape? Private credit is notoriously, well, opaque compared to public markets.
And that opacity is a significant disadvantage if you're just guessing at terms, right? So the second major application is real-time market intelligence. Borrowers need to know what market looks like right now for their type of company or asset.
Like, what's the going rate?
Exactly. What's the current pricing? What are typical debt yields? What are the standard equity kickers or warrant structures being used? You need to know if the terms you're being offered are fair or if you're potentially leaving money on the table.
Right, you don't want to get taken advantage of just because it's a private deal.
Precisely. So platforms leveraging AI and vast data sets like Prekin, PitchBook, and AlphaSense, all noted in the source, can provide really granular benchmarks across thousands of private credit transactions.
Fair sense, okay.
Yeah. They can help borrowers understand current pricing ranges, typical covenant packages, and structural nuances for deals in their industry or of their size. This arms the borrower with critical pricing intelligence and helps them structure their request in a way that aligns with current market expectations.
Which makes them seem more credible too, I imagine.
Definitely. It makes them a more attractive and credible counterparty. You're not relying on anecdotes or stale data. You're walking in with real-time, data-driven insights into fair terms.
Okay, that makes sense.
Exactly. And this directly leads to what I think is maybe the most exciting aspect of this shift counterparty due diligence.
You mean the borrower checking out the lender? That really feels counterintuitive to the old model.
It absolutely flips the script. Our source makes a really strong case that just as lenders vet borrowers meticulously, borrowers must vet potential lenders in today's market.
Why is that so critical?
Well, think about it. Not all private credit providers operate the same way. Some might be highly professional and straightforward, great partners. Others might have a history of, say, difficult workouts, or they might be overly litigious or even have hidden agendas or structural issues of their own you don't know about.
Yeah, getting into a long-term relationship with the wrong lender could be absolutely disastrous.
It really could. It's not just about getting the deal done. It's about partnering with someone who is the right fit and won't cause unexpected headaches down the line.
So how does AI help with that?
AI tools like SignalX, ReapRisk, and DoDil, which are highlighted in the source, enable this. Borrowers can use them to screen potential lenders for things like public lawsuits, regulatory actions, significant ESG controversies, or even uncover complex ownership structures or past controversies involving the fund principals.
So it's applying that same investigative rigor the lender uses, but pointed back at them.
Exactly. Now, the source does note that institutional borrowers probably have more resources to do this really deeply, but even basic checks available through these tools can flag major red flags for almost any borrower.
That's a powerful shift in dynamic. You're not just asking for capital, you're actually evaluating potential business partners.
Right. And there's a fourth area that kind of ties into this, unstructured data mining.
Unstructured data, like what?
Well, beyond the formal documents and structured databases, a lot of valuable information about lenders, their strategies, their appetite for certain deals, exists in less structured formats. Things like analyst reports, investor letters from fund managers, industry news articles, even social media sentiment, or maybe regulator comment letters.
So like digging through the noise to find the important signals.
Exactly. AI-powered platforms like Quid and AlphaSense, mentioned by the source, are designed to sift through this vast, unstructured data landscape. They can identify subtle shifts in a fund's investment strategy, perhaps reveal hidden relationships between parties, gauges market sentiment around specific lenders, or uncover commentary that hints at changes in their lending criteria.
So you get a much fuller picture.
It provides borrowers with a more holistic sort of 360-degree view of who they might be getting into business with, beyond just the numbers.
This is such a fascinating change in mindset. And if lenders and borrowers are both using AI, but maybe for different goals, the source includes a comparison table on this, right? What does that tell us about this power dynamic?
Yeah, that table is really telling. What's fascinating is how the purpose of the AI application changes depending on who is using it, even if it's similar tech.
Okay, give me an example.
So take document review. The lender uses AI primarily to detect borrower risk, right? And to ensure compliance with their own internal standards.
Makes sense.
But the borrower uses the same type of AI tool to spot unfair or unusual clauses being proposed by the lender and to strengthen their own negotiating position.
Ah, okay. Different objectives.
Exactly. Or market benchmarking. The lender uses it to evaluate their own pricing relative to their peers, making sure they're competitive but profitable. The borrower uses it to assure they aren't overpaying and that the deal structure they're getting aligns with current market norms.
Gotcha.
And the big one, counterparty risk screening. The lender vets the borrower thoroughly. Now the borrower is vetting the lenders. It's the perfect illustration of that flipping the script concept we talked about.
Yeah, it really is.
Both sides are armed with tech, but they're using the tools to achieve their specific, sometimes opposing, strategic objectives.
That comparison really highlights the strategic shift. And this strategic mindset for borrowers must show up in practical ways, too, like how they manage the due diligence process itself. My old school brain still pictures a data room as just, a room full of physical binders, or maybe just a shared Dropbox folder.
Right. And the source explicitly points out that the expectation today is fundamentally different. A static data room, whether it's digital or physical, just doesn't cut it anymore for serious private credit deals. Lenders expect dynamic, responsive, and incredibly well-organized virtual data rooms.
Okay, how does AI make a data room dynamic? What does that even mean?
Well, AI is really powering these next-generation data rooms. The source mentions tools like Dealroom, DocSend, and Answerada. AI helps automatically tag and categorize documents as they're uploaded, ensuring everything is correctly placed and easily searchable by the lender.
Okay, that's useful organization.
But it goes further. More importantly, AI can run checks against standard diligence checklists for that specific type of transaction. It can automatically flag if crucial documents are missing before the lender even has to ask.
Oh, that's proactive.
Very. They can also track lender activity, seeing which documents are being viewed the most frequently, which might indicate areas of focus or potential concern for the lender. This allows the borrower to anticipate questions or prepare further explanations.
Like seeing where they're spending their time.
Exactly. And they can automatically alert the borrower if key data, like maybe financial statements or asset valuations, are becoming outdated and need refreshing.
That sounds like it would streamline the whole back and forth nightmare that diligence can sometimes become.
It drastically reduces friction. It shows the lender you are highly organized, prepared, and transparent from the get-go. It builds credibility and definitely accelerates the whole process. It transforms the data room from just a passive repository into an active tool for managing the diligence process efficiently.
So AI isn't just providing individual tools here and there, it's enabling a completely different approach, a fundamental change in borrower behavior and strategy.
Absolutely. It fosters a shift from being reactive, waiting for the lender to find issues or ask for yet another document, to being fundamentally proactive. The borrowers who are really excelling in this market aren't just waiting by the phone.
They're anticipating everything, getting ahead of it.
Precisely. They're using AI before they even start talking seriously to lenders to identify potential partners and screen them. They're building out their dynamic data room and getting it ready before they even go to market.
Wow.
They're benchmarking their terms and preparing their financial story with real-time comps. And critically, they're performing internal due diligence on themselves, sometimes even hiring third parties to do it, as the source mentions. They identify their own potential weaknesses or risks and prepare explanations and mitigation strategies before a lender ever discovers them.
That's serious institutional readiness, as you called it earlier.
It really is. It's about demonstrating a level of sophistication and preparation that makes you an immediately attractive and, frankly, lower-risk counterparty in the eyes of the lender.
And that probably compresses timelines.
Hugely. Because lenders aren't constantly finding surprises or waiting for basic information. It saves enormous amounts of time and resources during the actual diligence phase. It sends a powerful signal. This borrower understands the process, they control their information, and they're operating at an institutional level. And capital flows to that kind of preparation.
Okay, let's try and bring this to life with that real-world example from the source. Someone wants to raise capital against a kind of unusual mix of assets, a portfolio of listed equities and fractional shares in a private jet. How does this AI-powered approach actually play out for them, step by step?
Okay, yeah, good example. Imagine you're that borrower. First, you need a clear, accurate picture of your equity portfolio and its liquidity characteristics. You could use a tool like Plaid or maybe Canoe, as the source suggests, to aggregate that data automatically from your brokerage accounts and analyze it quickly.
Okay, so data aggregation first.
Right. Then you have the private jet shares.
Hmm.
These likely involve complex co-ownership agreements, maybe existing liens or financing. Instead of manually reviewing potentially hundreds of pages of dense legal documents, you could use an AI platform like Kira's systems to quickly extract and analyze the relevant clauses related to ownership, transfer restrictions, or any existing debt on the asset.
So you understand the encumbrances and structure instantly.
Exactly. Next, you need to figure out how to structure the loan itself. Asset-based loans against this kind of mixed, somewhat illiquid collateral aren't exactly cookie cutter.
No, definitely not standard.
So you turn to platforms like PitchBook to search for historical precedents. How have other loans against similar luxury assets or diverse portfolios been structured in the past? What were the key terms, the covenants, the typical advance rates against those assets? This helps you propose a realistic and market-aligned structure from the start.
You're not just guessing how to put the deal together based on like one conversation.
Right. You're grounding it in data. And then, before you commit to a specific lender who offers terms, you do your counterparty diligence. Use a tool like SignalX to run a background check on that lender and maybe their key principles. Look for any history of litigation, regulatory issues, negative media coverage. Are they known for being difficult in workout situations? This is your chance to screen them out if needed.
Protecting yourself on the partner side.
Exactly. Finally, you'd set up that dynamic data room using a platform like DealRoom. You upload all your key documents, the equity statements, the jet ownership docs, personal financials, maybe third-party appraisals. The AI embedded in the data room helps organize it all logically and immediately flags if any standard documents typically required for this type of financing are missing, like maybe proof of insurance or specific compliance records related to the jet ownership.
Wow. So instead of potentially weeks or even months of that painful back and forth, chasing documents, clarifying things, and hoping you haven't missed anything critical,
you've proactively gathered, analyzed, and organized everything up front. You've researched the market structure, you've vetted the potential counterparty. You show up to the conversation not just asking for money, but presenting a fully formed, well-vetted package. The source really highlights that this compressed timeline, which is driven by front-loading all this work using AI, puts the borrower in a much stronger negotiating position.
because they look so prepared.
Yes, because they've already demonstrated professionalism, transparency, and a deep understanding of both their assets and the market's expectations.
Yeah.
It builds immense credibility.
It sounds almost too good to be true sometimes. It feels like these AI tools are just solving everything. But our source does include an important reminder, a caveat, doesn't it?
It absolutely does, and it's a really crucial point to make. While AI is revolutionary for speed, for pattern detection, for data analysis on a massive scale, the source is very clear. It doesn't replace human judgment. Experienced borrowers, their advisors, their legal counsel, they still play a vital role. AI can flag a potentially problematic clause in a 300-page document. But human expertise is needed to interpret its real-world implication and context, or predict how a specific lender might actually enforce it down the road.
Right, the nuance.
Exactly. AI can show you dozens of market comps, but human judgment is needed to understand why your specific deal might warrant different terms, or which lender profile, beyond just the numbers, is the best strategic fit for your business long-term.
So you can't just like automate the whole thing and walk away.
No, absolutely not. AI elevates the importance of judgment. It doesn't diminish it. Borrowers should use AI to enhance their understanding, speed up the tedious tasks, and arm themselves with data. But the strategic decisions, the negotiation nuances, understanding the human element of a lender relationship, that still requires experienced minds.
Okay, that's a really important balance. So to kind of wrap this all up, what's the core takeaway here? In this increasingly competitive and selective private credit market that we're seeing, who really has the edge going forward?
Well, the source makes it very clear. The winners are the borrowers who understand that due diligence is no longer just a passive chore they have to endure, but it's a strategic function they need to own.
They take control.
They take control of the process, they professionalize their approach, and crucially, they leverage these AI tools strategically to move faster, gain deeper insights into every aspect of their own business, the legal documents, the market comps, and, importantly, the lenders themselves. They negotiate from a position of informed strength.
It's really about being the most prepared person or team in the room.
Exactly. The key takeaways summarized by the source reinforce this perfectly. Build those institutional-grade data rooms proactively, run real-time lender and market diligence on your own side, and understand that by front-loading this credibility and insight, you dramatically improve your chances of closing faster and likely on better terms.
So the message is clear.
Yeah. In 2025, private capital is increasingly flowing, not just to the best business opportunities on paper, but to the best prepared borrowers. Preparation is key. Thinking about this sort of arms race where borrowers are now leveraging AI so effectively for their own diligence, doesn't this inevitably put pressure back on the lenders? I mean, if borrowers are showing up incredibly well-informed, potentially knowing as much about the market, or even the lender's own history as the lender knows about them, how might lender due diligence processes, or maybe even their required level of transparency, have to adapt in response to that?
That's a fascinating thought. The dynamic definitely feels like it's evolving, maybe becoming more balanced or at least more transparent in both directions. Something to watch. Thanks for listening. If this helped or made you think, hit like it shows this content matters. And tap subscribe if you haven't yet. See you next time.